Today we want to talk about our second quarter outlook for markets. Stay positioned for global reflation. David, in terms of the investment landscape, looking across 2Q and into 2021, how do you think the investment landscape shapes up?
Well, in terms of our theme, John, positioning for global reflation, what we really mean by that is we expect quite a significant recovery in the global economy, both through 2021 and likely 2022. So that'll mean corporate profits strengthen quite significantly through those years. So we think that's a good backdrop for stocks, particularly when you look at interest rates, they're still relatively low. So with that backdrop of low rates, improving profitability, we think that's a good backdrop for equities. So we're still constructive on both global and domestic equities in particular.
David, the threat of inflation is talked about in markets at the moment. How are you seeing that threat? Is it real? Is it something investors need to consider over the course of 2021?
Yeah, I think it's a very interesting question, John, in terms of the outlook for inflation. It's the key to the outlook for interest rates, which in turn really is the key to the outlook for the equity market. So it is a critical issue. We're looking at it very closely. We do think there's going to be a pickup in global inflation in the second quarter, partly because of base effects. We had deflation when COVID was at its peak last year in the second quarter. So you'll get that base effect. And we're also seeing some cost pressures in the global supply chain at the moment. So there will be a pickup in inflation temporarily in the second quarter. But I think the market knows that. The Fed's flagged that. The RBA's flagged that. But beyond that, we think inflation will start to moderate again in the second half of the year. It'll probably pick up again in 2022 and 23. But overall, we think the outlook for inflation over the next year or two is still relatively moderate. So we still think it's a fairly friendly backdrop for equity markets. So John, that's our global view on inflation. How do you see the local backdrop for inflation?
Broadly similar, David, to what we're seeing offshore. I don't think the dynamics locally are that different to what we're seeing offshore. We've got capacity on the labour front. I think it's different to what we saw back in the noughties, where we effectively ran out of people. We ran out of human capital, and we had very, very buoyant for a sustained period of resource and capex going at the same time. I don't think we get that running at the same rate as what we did in the noughties. So I think locally the inflation pulse is going to really lag what we're seeing offshore. There'll be some transitory local inflation issues, but I don't think that's going to spill over into wages, which is what we're really watchful of. So long-term guidance from the central bank, they're going to be quite hesitant to lift at any signs of inflation. I don't think the domestic inflation story over the next 2 years unravels the case for equities. David, value growth has been a popular narrative over the last 6 months and has continued to be a feature of equities and bonds this last quarter. What's driving that value growth rotation, and is that expected to continue?
Yeah, John, I think there's a couple of related factors there in terms of that dynamic. I think firstly, markets are increasingly factoring in recovery. So that's impacting bond yields, which is causing some of that rotation. But it is also as the promise of better profit growth out of these previously depressed value sectors like financials, materials, energy. So in the last 5 months, we've seen quite a strong rotation back towards so-called value stocks, both globally and domestically. We think there's probably more to come in that rotation from the perspective of seeing more upside in bond yields and economic growth and profit growth. So we think there's a bit more to come there in terms of the value rotation, certainly at the global level. It's probably maybe a little bit more advanced domestically, but I think, we still, from your perspective, tilt towards value in terms of the domestic portfolio?
Yeah, very much so. The Aussie market has quite a cyclical nature to it with banks and resources is circa 50% of the market. So we're saying to clients, you need to own the banks, you need to own the resource companies at the moment. That's where we can get benefits of the global recovery as well as relatively depressed valuations relative to their history, and particularly in the case of the financials, the banks, 5 years of underperformance, we've seen a handful of quarters where we've had outperformance. So there's quite a big pathway, particularly on financials, for that relative performance to close before we might need to think about neutralising that call. But certainly playing the cyclical elements within client portfolios at the moment, I think has more preference relative to the what can be quite expensive structural growth companies. A little bit of a pause there, point your money more towards the cyclical plays at the moment. David, the backdrop for markets sounds reasonably constructive. It's probably a useful backdrop for more than just equities. Alternatives are something we play here at Wilsons. How are you seeing the outlook for alternative investment classes?
Yeah, as we said, John, we're overweight alts as a complement to equities. We think alts are a very useful portfolio diversifier at a time of very low interest rates. So at the moment, we really think about alts in terms of 5 sub-asset classes we're positioned. So private equity, private debt, global hedge funds, equity hedge funds, infrastructure, and also we have a moderate allocation to gold. We think that balance of growth alternatives and defensive alternatives is a good diversifying mix, and we think that does complement the equity exposure quite well. So we're happy to be overweight alts over the next 12 months at least. So John, thinking about the upcoming quarter, how do you see the outlook for both the Australian equity market and the economy more generally?
So I think for the Aussie market, equity investors are going to be looking at 2 things from the macro. Is there any slowdown in momentum with some of the forms of government assistance, JobKeeper, some of the job programs winding back? And then secondly, in May, we've got the federal budget. We're going to have a smaller deficit than what was only forecast at Christmas time. And I don't think we're going to be going back to surplus over the next 12, 24 months. So just what the fiscal pulse is post the May budget, I think will be important for equities. From an equity specific standpoint, I think the 2 big events over the next quarter, we've got the bank results season in early May, which will be very closely watched, and we're looking for a pathway to potential capital management later on in 21. And then secondly, May is often a confession season, an earnings confession season period, typically in Australia. Companies revising numbers, often downwards, ahead of the end of the fiscal year. Our view is that the earnings upgrade mode that we've seen for the last 6 to 9 months continues, and we actually see a very modest confession season of sorts here in Australia, similar to what you were saying in terms of the global cyclical pulse. That's still pretty strong in Australia. Companies with very few companies with guidance out there. So I don't think we're going to see a big handbrake on earnings and therefore the market through this second quarter because of the typical confession season, less relative to history in May.